I know a lot of the conversations that you're having with clients is basically about these higher interest rates, where they end up, and actually what it means for the underlying economy and businesses.
Yeah, definitely we have seen higher interest rates that we have seen in more than a decade. And we are seeing the impact in a few asset classes of these interest rates. Like one of these impact is in mortgage rates. We are seeing mortgage rates in the US at the highest since early 2000. They are at about 7.7% rate. That they might have impacted the economy via the fact that people are not quite moving home because they need to refinance, and obviously refinancing is expensive, which means that if you have to take a job from another place, you need to put the debt into consideration. So that might have an impact in the economy. The other part where we are seeing the impact is obviously corporate borrowing. So corporations have put themselves ahead and they have tried to borrow on the longer term for many years when the rates were lower. But still we have about 3 trillion of debt that is coming into maturity within the next 5 years, which is a really chunky number. So we'll have to see what that means in terms of stress to corporations. At the moment, we are seeing default rate going up. Moody's estimates them around 4.5%. But what I'm trying to say is that they are up, but the situation is still fairly benign.
Yeah, which I'm surprised about. I don't know whether it's something that you surprised. I mean, you're really in the markets. You look at, quantum analysis. You're speaking to clients. Would you not have expected to see more distress to where we are? And, how difficult is it to explain this?
I think that the reason why the situation is not so distressed, I mean, in the mortgage space is because, as I said, the house prices have kept high, and they have kept... And they have kept high because there is little supply. On the corporate side, as I said, there has been provision through the years in order to make sure that to borrow when rates were lower for a bit longer time. And in general, you can see that corporates are a bit less levered than we are talking about in 2007. Now, obviously, it's a very different scenario. And when we talk about it, we always talk about, this is like the highest that we've seen in 20 years, or is the highest rate that we have, the Bank of England. There was the headline earlier, the Bank of England rate is the highest in 15 years. So the point of is that makes it the job of the quant that can't rely anymore just on backtest. So normally, when we build strategy, we think about the backtest. We look at what happened in the past. That's not enough. We really need to incorporate what we think is the outlook, what we think is some realistic assumption in our model. That is really the major change.
Giuliana, when you look at COVID, has it changed, everything? Because people were saving, and I guess behavior has probably changed at the margins. I don't know whether it's changed enough to look at actually how corporates and also households behave.
I think, from my point of view, and I'm a quant, right, at the end of the day, but I think from my point of view, interest rates have changed more than the actual impact of COVID. So if you look at the impact of COVID, there is still some of it. I think that if you look at in the US, I think that US house supply is not as high, but not just from the household point of view, even from the construction point of view. We are not back at the pre-COVID level. But I think that what we are seeing from my point of view is really the impact of high rates.
When you look at, so what are your clients asking? I mean, a lot of the questions surrounding that, but are they asking also, are they looking at the models and asking you specific things that they wouldn't have asked a year ago?
I think that the major question we are getting is about cash efficiency. I think being cash efficient is more important today than it was when there were low interest rates. So that is the major topic that we are seeing at the moment. Obviously, now you have the performance of the fund versus a 5% rate. And that is the major point of discussion.
And that's actually going to be the case for the foreseeable future, right? Until interest rates start going down, which could be a long time away.
Well, if you listen to most of the banks, the central banks, they are saying that interest rates are there for longer. So yeah, it's going to be the case for a while. Yeah.
And Giuliana, when you look at some of the quant analysis, how do you tweak it from, if not country to country, like region to region, because of some of the peculiar dynamics, I guess?
So I think that what we try to be robust, right? So I mean, when I was telling you about the back test and when I was telling you about looking forward, is really about building a robust model. And the more robust model is the one that works in different regions. So we really try to, obviously there are some region-specific effects that you may want to capture, but I think that the main idea is like trying to be robust across regions.
I mean, you've worked actually in quants for quite some time, and I think you came on
years.
about, I think last year you came also on the program, we were talking about it for the first time. How has the models changed? How has it developed, and also client appetite for understanding this changed?
So I think that when I started, there was a lot of trend following, and loads of the research was about diversifying trend following across markets. So going back to your question, it was an effect that was present in many markets. We were trying to diversify across all the regions. Now what's changing is that we are looking more at effects that are non-trend following, and they can diversify in terms of the signal. So it might be still across region, but it's not necessary, and it's really more about that. In fact, you can think of this year, one of the styles that has worked has been equity market neutral effects, and that has been one of the best performers this year.
But is that because the market is more complicated, or just because quant analysis has become better, more advanced?
I do think that we advance, right? I think it's more about advancing, it's more about like improving signals and so on. But obviously there has been major changes in the market. We discussed earlier credit, right? Credit is one of the markets that has become more electronic, has become more automated. And that obviously has changed the dynamics, has made it possible for quants to enter into that space that maybe 10, 15 years ago was more challenging because it was all voice traded.
Yeah, that's such a good point. Is there any other part of the market that you're expecting quants to become bigger because the way the behavior of the market is actually changing?
I think that at the moment the focus of quant has been in the very liquid markets, right? I think that there is going to be more presence in the market that are maybe less liquid. That's what I see in the future. But the liquid market will be always the easier part for quant to trade.
Well, I don't know about easier, but certainly you do it very well.
Well, I mean in terms of like liquidity, right? So let me explain what I meant by easier. So what I mean is that when you go into credit, just to stay on the topic of the credit that we touched earlier, you are not sure if you're going to be able to execute. You need to put loads of assumption in. Am I going to be able to trade this bond or not? When you are in the liquid space, you don't have that problem.